Hello there, you're watching Bizworld. Malaysia's inflation rate continued to increase at a slower rate, falling to 1.5% in November, with the index points recorded at 130.9 against 129 in the same month of the previous year. Meanwhile, the country's consumer price index CPI edged lower to 1.8% in October from 1.9% in September. Chief Statistician Datuk Seri Muhammad Uzir Mahidin said the increase was driven by the lower increases in restaurants and hotels at 4.3%, food and non-alcoholic beverages 2.6% and health 2.3%. Inflation in Malaysia was lower than inflation in the Philippines, Vietnam, Republic of Korea and Indonesia. Prime Minister Datuk Seri Anwar Ibrahim has mandated government-linked investment companies, GLICs, to increase their respective domestic direct investments. This is crucial to drive economic growth and expand the income of the people. While chairing a meeting with the CEOs of GLICs, Anwar noted that with the total size of assets under management worth 1.84 trillion ringgit, which is almost equal to the size of Malaysia's nominal GDP, GLICs are capable of moving and accelerating Malaysia's economy. GLICs and GLCs should also increase investments in the digital and renewable energy sectors, as well as encourage the micro, small and medium enterprise MSME sector to expand to regional countries. Among these suggestions are making better use of expenses from corporate zakat collection, collaborating to develop student accommodation and mobilizing more funds for the investment in the SME sector. Fitch Ratings expects Malaysian benchmark crude palm oil spot prices to average $650 per tonne next year, substantially lower than around $840 in 2023 due to higher supply. It added that there is a risk of a large drop in palm oil output due to the ongoing El Niño climate pattern, which causes drier weather in Indonesia and Malaysia. However, the rating agency thinks the impact is unlikely to be material based on the substantial rainfall seen in the region over the last month and the forecast by the US Weather Service of a 60% chance of dissipation of El Niño conditions by June next year. Policy interest rates in the United States, the Eurozone and the United Kingdom have now likely reached peaks for this tightening cycle after being on hold since the third quarter. According to Fitch Ratings, rate cuts are now expected from the US Federal Reserve, the European Central Bank and the Bank of England. Fitch expects policy rates to fall by 75 basis points by the year end of next year in all three economies. It also noted that major central banks have kept their policy rates unchanged in recent months, and the headline consumer price index has fallen quite quickly, coupled with earlier monetary policy tightening, resulting in a rapid slowdown in household and corporate credit flows. Oil prices rose as much as 1% on Friday as tensions persisted in the Middle East following Houthi attacks on ships in the Red Sea. Although Angola's decision to leave the Organization of the Petroleum Exporting Countries, OPEC, raised questions over the group's effectiveness in supporting prices. Brent crude futures were up 1.1% to $80 a barrel by 0409 GMT, while US West Texas Intermediate crude futures were up 1.1% at more than $74 a barrel. Both the contracts are also up over 4% for a second consecutive week as concerns over shipping in the Red Sea buoyed prices. According to analysts, oil prices could see a rebound due to the geopolitical conflicts and the imminent implementation of OPEC production cuts. And that's all the time we have for Bizworld. I'm Azaria Tagaya. Thank you for investing your time with us and stay tuned to TV3.